Hello everyone, welcome back. Today we're doing the ADAS model or the aggregate demand, aggregate supply model. This is an excellent model because it's a very simplified version of reality, the real world that we live in, yet it gives us an excellent understanding of how economic factors and policies can simultaneously affect our real output and the aggregate price level. So business cycle fluctuations that we have been referring to throughout the course are very nicely explained through this model, how when one factor or a shock hits the economy, it ends up generating a business cycle upturn or a business cycle downturn. The model has three main components: aggregate demand, short-run aggregate supply, and the long-run aggregate supply. Let's start our discussion with the first component, which is our aggregate demand. Aggregate demand will give us a relationship between the aggregate price level and the quantity of aggregate output demanded by all sectors in the economy. Assuming it's an open economy, it will have its own households spending on final goods and services in terms of consumption, the government spending on final goods in terms of government purchases, businesses spending on new physical capital in terms of investment spending, and the rest of the world spending on our final goods and services in terms of net exports. So the major components of aggregate expenditure, we're going to look at them together and see how is that total aggregate expenditure related with the aggregate price level. We typically observe that whenever the aggregate price level decreases, aggregate output demanded is going to increase. As you can see over here in the 1930s, as aggregate price level is going down, output demanded is increasing. So why do you see this negative or inverse relationship between aggregate price level and aggregate output demanded? There are two main reasons for that. The first one is called the wealth effect of the change in aggregate price level. So what happens over here is that when your price level changes, so let's assume price level is going up, it causes our real wealth to go down. So the purchasing power of your wealth goes down. And for households, when their real wealth goes down, they will reduce their consumption spending. And as households can reduce their consumption, which is a major component of overall aggregate output demanded, we see quantity of aggregate output demanded going down. And that gives us our negative relationship between these two. Another reason for the downward slope is the interest rate effect. And in this case, again, as the price level, let's assume, is going up, it's going to reduce the purchasing power of your money balances. As money is now losing value, people will need to borrow more, and with higher borrowing, interest rates are driven up. Now, interest rates, remember, are your cost of borrowing. So at the higher interest rate, both consumption spending and investment spending by firms is going to go down. So remember, consumption is by households, and both of these are components of our aggregate output demanded. So you can see higher price level is causing overall output demanded to decrease. Together, these two generate this downward slope in our aggregate demand curve. Now, movement along the aggregate demand curve is because of changes in the aggregate price level. But what causes the aggregate demand curve to shift? Shifters could be changes in expectations, wealth, stock of physical capital, government policies like fiscal and monetary policy. When any of these factors change, it will cause our overall aggregate output demanded to be higher or lower, thereby generating a shift in the aggregate demand curve. So a shift is when the entire set of coordinate points is now higher to the right or lower to the left. So in my first panel over here, you can see aggregate output demanded is higher at any given price level. Whether price level is the lower one, P1 or P2, correspondingly, we have a new set of coordinate points depicting an increase in aggregate demand. Likewise, if at any given price level, you see aggregate output demanded decreasing, that will cause a shift to the left or a decrease in aggregate demand. Let's look at these shifters in a bit more detail and see how changes in them will cause AD to increase or decrease. So the first one we have here is our changes in expectations. Now it can be changes in expectations for firms or for households. If firms or households become more optimistic about the future, they're going to start spending more today. So that is going to cause your consumption or investment, or maybe both, to increase. And since consumption and investment are increasing at any given price level, it is causing your aggregate demand curve to increase or shift to the right. Another major factor could be changes in our wealth. Consumption spending is largely driven by household wealth, and housing, for example, is a major component of our portfolio of wealth. As housing appreciates, real wealth of households is now higher, and with this increased purchasing power of their wealth, they're going to start spending more. And with the increase in consumption spending, aggregate demand increases or shifts to the right. strength. Note, in both these cases, nothing has happened to the aggregate price level. So this is when your quantity of aggregate output demanded is higher at any given price level, causing the curve to shift. Another major component that affects our aggregate demand is our size of existing stock of physical capital. Firms will typically engage in planned investment spending to add to their stock of physical capital, and their incentive to spend partially depends upon how much existing stock of capital they already have. If they already have very high stocks of physical capital, they might have a reduced incentive to engage in additional investment spending. So we see economies which have high stocks of physical capital having a decline in their investment spending, causing their aggregate demand to decrease or shift to the left. Whereas economies which have low stocks of physical capital stock have a huge incentive to pursue additional investment spending, and they see higher investment and therefore increases in their aggregate demand, which generate a rightward shift in the AD curve. The main idea over here is that the more you have, the less you will have the need to add more, causing your investment spending to go down. As an example, think of a firm which buys a lot of new machinery, equipment, computers for its workforce. So once it has put all of those new things in place, it doesn't need to invest more in the subsequent year. So if you already have high stocks of physical capital for your workers today, in the next time period, you will now be overall reducing your investment spending. You may be still buying more physical capital, but not as much as you have already done in the previous years. And that causes this decline in investment spending for this particular time period, causing the aggregate demand to decrease in that particular year. Another example of this we saw just before the financial crisis of 2008, which saw housing investment declining by almost 13%. Now, why did housing investment decline by such a large amount? Because in the years leading up to 2008, we actually had an oversupply of housing. So once you already have a lot of housing available, firms, especially the construction industry, stopped investing further in that particular sector. And that causes investment to decline and therefore aggregate demand to decrease and shift to the left. Lastly, we have our stabilization policies, fiscal and monetary policy. Fiscal policy tools are your government purchases, G, taxes, and transfers. When we have expansionary fiscal policy, the idea is to stimulate aggregate demand. So expansionary fiscal policy is conducted through higher government purchases, higher transfers, or reduction in taxes. All three on their own will stimulate our overall aggregate output demanded and therefore cause a shift in the aggregate demand curve to the right. If we have contractionary fiscal policy, the aim of which is to dampen spending, it could be done through reduction in government purchases, reduction in your transfers, or increase in taxes. Again, these are going to affect our aggregate demand and causing it to decrease at any given price level, which will be reflected as a leftward shift on our aggregate demand, aggregate supply diagram. Government purchases directly affects our AD, because it's a major component of our aggregate output demanded. Whereas taxes and transfers are going to affect our consumer spending. Taxes and transfers affect our disposable income of households, and once they affect the disposable income, they will affect the consumption spending of households. Households, remember, spend out of their disposable income, and if disposable income is overall higher, they will end up spending more. If disposable income is going down, they will end up spending less. Likewise, we see monetary policy having a huge impact on aggregate demand. Monetary policy is when your central bank changes our interest rates and money supply. When the Bank of Canada wants to stimulate aggregate demand, we call it expansionary monetary policy. And this will be done through reduction in interest rates and increase in money supply. As the central bank increases money supply, people now have more funds than they typically need for their purchases, and they're going to reduce their borrowing. With reduction in borrowing, interest rates are driven down. With lower interest rates, consumption and investment are going to increase, as a lot of the spending is dependent upon borrowed funds. Both are components of AD, therefore aggregate demand increases or shifts to the right. In case of contractionary monetary policy, it's just the opposite. The central bank, Bank of Canada in our case, reduces the money supply. With less money in hand than households typically need for their purchases, they will borrow more, driving up the interest rates. And as interest rates are driven up, investment and consumption will go down, causing our aggregate output demanded at any given price level to be lower than before. And that will generate a leftward shift in our aggregate demand curve. So whenever our policy is expansionary in nature, whether it's fiscal or monetary, it is going to stimulate aggregate demand. In the case of fiscal, it can be through increasing government purchases, transfers, or reducing taxes. For expansionary monetary, that was reduction in our interest rates. Whereas whenever the stabilization policy is contractionary, whether contractionary fiscal or contractionary monetary policy, we will see dampening of aggregate demand, or AD decreases, and on our diagram, it shifts to the left. For policymakers, it's extremely difficult to shift your aggregate supply curve, and therefore we see typically stabilization policies are going to only affect our aggregate demand curve. Now let's look at aggregate supply, which is the second component of our ADAS model. Aggregate supply has two forms. We make the distinction between the short-run aggregate supply and the long-run aggregate supply. Aggregate supply curve will give us a relationship between the price level and the output produced by firms in our economy. So we're focusing on the supply side of things. In the short run, this relationship between price level and output supplied is going to be a positive relationship. And the main reason behind this positive relationship is because wages are sticky in the short run. Sticky wages mean that if I go ahead and ask for an increase in my wage rate today, my employer is not going to immediately listen to me and respond by increasing the wage rate. Likewise, if my employer wants to push the wage rate down, I'm not going to immediately agree to that. So in the short run, we see that wages are sticky. They do not respond to labor shortages or labor surpluses immediately. So in your typical market diagram, wage rate will increase if we have a labor surplus or high unemployment, pushes the wage rate down. And whenever you are experiencing labor shortages, it will push the wage rate up. So these market dynamics will eventually happen, but not immediately because of the labor contracts that we're stuck in or because of strong labor unions. We see that wages do not respond very quickly. So in the short run, wages are pretty much stuck at some level and we refer to them as our sticky wages. Now what happens when they are sticky wages but the price level is rising? Now the aggregate price level is going to have an impact on the profits of firms. In order to see that, let's write our profit equation. Profit is total revenue minus total cost. Wage, remember, is a major component on the cost side for firms, whereas prices are going to be affecting their revenues. So if the aggregate price level is going up, their revenues are increasing, costs are pretty much not changing and causing their profitability to increase. With higher profits, firms have an incentive to produce more in the short run. And therefore we see this positive relationship between aggregate price level and aggregate output supplied by firms. Remember, for this to be true, a major assumption is that wages are sticky. If wages were to catch up along with the price level and move in the same direction, we would not see this positive relationship. So with sticky wages, we see a positive relationship between aggregate price level and the quantity of output supplied by firms, giving an upward sloping short-run aggregate supply curve. In this diagram, we have the aggregate price level in terms of the GDP deflator on the y-axis and a real GDP or y on the x-axis. And you can see there is a positive relationship between the two variables. As price level is decreasing, aggregate output supplied is also correspondingly lower. And this positive relationship is captured by the upward sloping short-run aggregate supply curve. Now, what causes the short-run aggregate supply curve to shift? So when any factor other than the aggregate price level causes firms to produce more or produce less, that will cause a shift in our short-run aggregate supply. Now, what causes firms to produce more or produce less? A major incentive mechanism for firms is profits. Anything that causes their profits to be higher, they're going to produce more. Anything that causes their profitability to become lower, they're going to produce less. So some major reasons for profits to change are your commodity prices, nominal wages, and productivity. Changes in commodity prices refers to prices of major inputs. So inputs that are used in bulk amounts in your industry. So this could be cotton for textile industry. This could be steel for your manufacturing industry. So any major input. Let's assume price of steel, which is a major input for your manufacturing industry in Canada, goes down. Now, if price of steel is going down, this is a commodity price, not your aggregate price level. So please do not confuse it with our overall measure of price level. As firms see a major input become cheaper, their profits are going to be higher. And with higher profits, they have an incentive to produce more in the short run. And therefore, our aggregate supply curve increases or shifts to the right. Next, we have changes in our nominal wages. If we now see higher nominal wages, higher wages are again going to affect the firm's profitability. And again, wages are a major cost for firms. So with higher wages, their costs are actually going up and causing their profitability to be lower than before. And with lower profits, the incentive for firms is to produce a lot less in the short run at any given aggregate price level, causing the short-run aggregate supply curve to decrease and shift to the left. So our short-run aggregate supply moves from short-run AS1 to short-run AS2. Decrease, remember, is always to the left because we're measuring production on the x-axis, and increase is always to the right because again real GDP is being measured on the x-axis. Enhancement in productivity means that your workers are able to produce more with the same amount of resources. So their raw material, capital is exactly the same as before, but technology perhaps is increasing their ability to produce more. Higher productivity therefore reduces the cost of producing the same amount of output produced by firms because they can now produce the same output with a lower amount of resources, thereby increasing their profitability and a huge incentive for them to produce more in the short run. Short-run aggregate supply curve will increase and shift to the right. So these are the three main factors that shift our short-run aggregate supply curve. Remember, a shift is always when something other than your aggregate price level is causing our production to change, whereas a movement along the curve would be when the aggregate price level itself is higher or lower. Remember, we made this distinction between short-run aggregate supply and long-run aggregate supply. And in the short run, our assumption was that wages are sticky. For the long-run aggregate supply, we are now going to assume wages are fully flexible. Wages now have enough time to respond to labor market shortages or labor market surpluses. If there is high unemployment, wages are going to go down. If there is a huge labor shortage in your market, wage rate is going to go up. Another thing to note over here is that wages typically follow the direction of the price level. If price level is rising, wages will eventually catch up and also rise in the long run. If price level is falling, wages will also eventually follow and go down in the long run. So now let's look at the relationship between aggregate price level and output supplied, having understood the fact that in the long run, wages are now fully flexible. And again, in order to understand this relationship, I can write my profit equation. For a typical firm, profit is total revenue minus total cost. Wages are a component of your costs, and your aggregate price level reflects your prices of your final goods and services. Therefore, changes over here will be affecting the revenue of firms. So if prices are now going up, we know that wages are also going to increase because they're going to catch up. They're fully flexible. So for a typical firm, both revenue and costs are rising proportionately in the long run. And if they both rise proportionately, profits are not changing. And if profits are not changing, there's no incentive for you to produce more or less as a firm. And therefore, your output is not changing in the long run. And if output is not changing in the long run with changes in price level, what is the shape of our long run aggregate supply curve? So my long run aggregate supply curve is a vertical line constant at y bar. This output level is what we call our potential GDP. Now potential GDP is your output that you're going to produce when all resources, remember, are being used efficiently. Your resources of land, labor, capital, natural resources, all of them are being used at their efficient level. They're not being underutilized and they're not being overheated. Here's a slightly neater version of my diagram. So our potential GDP does not respond to changes in the price level. It depends rather on our underlying technology, our underlying stocks of capital, labor, natural resources, the type of human capital we're working with. So it does not depend upon our aggregate price level as your short-run aggregate supply does. Remember our business cycle diagram from chapter 6? This is the exact same diagram. You can see our GDP is alternating between expansions and recessions in the short run, and these short-run alternations are actually around some potential level, and the potential level is given to you in this blue line that I have stretched across this diagram. For any given year, your actual GDP can be higher than potential, or your actual GDP can be lower than potential. So for example, in the 1970s, we had a major recession in the business cycle. So actual GDP is below our potential for that given year. Note that potential is not stagnant over decades. Over time, because of improvements in your productivity, technology, potential does also change. However, for any given short run, we can always see the output gap in terms of how much are we producing today relative to our potential GDP for that particular time period. So for example, in 2009, we were in a major recession. Actual GDP in 2009 2009 was a lot lower than the potential for that period, but the potential itself has changed since the 1960s or 1970s. Potential output can change if we have enhancements in our productivity. Productivity primarily increases because of technology, human capital, and our stock of resources or inputs. So these are some sources of long-term growth. If the economy experiences growth in the long run, its potential will change. In terms of our ADAS diagram, our potential is now at a higher level, so the long run AS curve will shift to the right and will be vertical at this new higher level of potential GDP for this economy. However, note that your potential does not depend upon your input prices or your factor prices like wages, commodity prices, etc. If there are changes in the economy which are significantly hampering its long-term growth, the potential can also decrease in the long run, and therefore the long run aggregate supply curve will be now vertical but at some lower level of potential GDP.